Welcome to the weekly video update, where I'll go over the action in the market for the week of November 20th through the 24th, and then we'll see how things look for the week of November 27th through December 1st. It was a pretty sleepy week, not a real surprise. It was a holiday week. The market was closed on Thursday, had an abbreviated session on Friday, but we're looking more positive. Now, when we switch over to the daily charts, we are overextended to the upside in the short and intermediate term, but we're still hanging in there. We're not seeing an awful lot of selling coming into the market. As folks come back after the holiday, there'll probably be a pickup in volume. There'll be a pickup in interest. We'll be paying really close attention to all the economic reports that are coming out, and then the market will continue to develop this scenario, whether it wants to go higher or lower. Now, before I get started, please know that there's a PDF in every video that I post. That's for YouTube and Rumble. Some folks find it pretty helpful to be able to download what I use in the video. You can see the slides that have text. You can see the charts that I use. Sometimes it's a little easier to see those to follow along. Also, every day on the YouTube channel, on the community tab, I post what are called pivot points. Now, one chart that you see has pivot points that last for the whole month. I only update that because each day a new bar is added to the chart. The ones that I really pay attention to are the intraday pivot points, and these can be support or resistance levels that are calculated the day before, and sometimes they can be very insightful as to intraday movement that we see going on in the market. So feel free to check those out. I do have a private Facebook group. It's not really active, little back and forth here and there. If you want to join and become more active, I could step that up a little bit. Right now, I'm pretty much just posting the links to the videos as I post them on YouTube and Rumble. I will be going over the results for the poll this week. I'll be then posting another poll after I upload this video, and just to see how you feel about certain things. If you ever have a question that you want me to ask, feel free to put that in the comments or send me an email. I really watch YouTube comments, and I'm also watching Rumble comments. I'm getting a lot more garbage over there as well. I want to take out the bot comments, the spam comments, and the comments that just have nothing to do with anything. I want that to be an open back and forth, whether you agree or disagree with the conclusions that I've reached. If you want to state something, you're more than welcome to do that. But I want it to be legitimate and fair. So please feel free to do that. But also know that if you see some garbage on there, it's probably not going to stay there very long. I do also post on YouTube and Rumble, and here's a link to that site. If you can't find me on one platform, feel free to switch over and look for the video that I post on the other platform. Let's go back and talk about what happened. For the week, we were up 1%, still an up week. Wasn't a real gangbuster week, but it was a positive week. We were well below average with volume, not a real surprise. Holiday week, one of the days shortened. A lot of folks ended up taking the whole week off anyway. We are positive now with the technicals. We're looking a little overextended on some of the daily charts. We're underneath some resistance. If we try to go up, the market's going to have some power to really break through that. On the weekly chart, you'll notice that there is some improvement as well. And so things are showing some more positive sides as we look through all the charts. Our trend is still weakening. The ADX is going down below the 20 level, and it's also below its moving average, but the green line is on top, so we would still default to the positive side. On the daily charts, we're positive there, both in the short and intermediate term, but we're looking a little overextended with the green line. We're getting up near a very high reading, which sometimes can mark exhaustion. Other times it can actually mark a reversal. So for the week, the Dow was up 1.3%, the NASDAQ was up 0.9%, the S&P was up 1%, and the small caps, which are showing some improvement now with the Russell 2000, were up 0.5%. Some notes that we can take away from the week: the markets were closed on Thursday for Thanksgiving Day. I know that goes without saying if you're an American, but there's people outside of the US that watch these videos. That's why the market was closed on Thursday, and we had the really abbreviated day on Friday. Trading volume was below average. Again, not a real surprise given that it was a holiday week. buying was more broad-based. We are seeing some improvement across the market, and that's really helping things. Where most of 2023, it's been the mega caps that have been performing well, and they did okay this past week also, but now we're seeing a little bit more participation. NVIDIA did come out with their earnings after the close on Tuesday. It was one of those classic ideas where you buy the rumor and that pushes the stock price up. And then when the news comes out, even if it's wonderful news, folks tend to end up selling, and we call that selling the news. On Wednesday, or was it Tuesday? I don't remember. It was on one of the days this past week, we had the FOMC minutes that came out, but they didn't really say anything new. So the market didn't really react to that very much at all. For the most part, earnings are being taken as positive. We'll get more earnings in the upcoming week. Economic data was weak. Now, the market has developed a scenario that we're in a pretty good spot for right now, and we're going to be watching that. If we see the general trend of economic reports coming out stronger than expected, that might mean that the Fed is going to raise rates, and that could really freak out the market. If we start to show continued weakness, that could freak out the market, because then we're saying, oh no, this economic growth could be going away. That's more deflationary, and the market could freak out over that. So right now, the market seems to be kind of in a sweet spot, not too hot, not too cold economically, and that's helping to give support to stocks. Interest rates were up on the week, and the dollar declined. We're also looking at sentiment overall. One of the gauges that we use is called the VIX, and this is an average from 1990 to 2022. I go through this in every daily video. As we get into the end of November and to the beginning part of December, we tend to chop a little bit sideways. There's some other research that we have put up by Carson suggesting that maybe the early part of December can see some weakness before we see positive seasonality going into the end of the year. Doesn't mean that's how things are going to play out. We just use this as kind of a guide. But so far in November, the VIX has been really dropping, and I have some charts to show you of that. We're also keeping an eye on inflation. Now, earlier in the year, there was a comparison made between 1966 to 1982. That's the blue line. And up until the end of June, we were following that. I haven't really updated this chart. We don't know if things are going to play out this way, but earlier on, it did look like there was a pretty strong correlation between the two. If we do follow the same basic pattern, we're still in that period where we see a lessening of inflation. But unfortunately, after that, at least what happened in the 1970s, we ended up really skyrocketing with inflation before it started to come down in the early 80s. We're not sure if it's going to play out this way like it did back then, but again, we just use this as a guide. And we're also keeping an eye on the RenMac research. They put out something on Twitter about a month ago, maybe even longer than that, where we look at the 10-year yield. And according to what they found, when we are above 4.02%, that's when it starts to bite into corporate profits. Currently, we're at 4.47%. So we're above that level, and that could be having an impact. Getting into the poll results, the first question, and now this was a week ago, where I said longer term, the S&P remains below a weekly trend line. Do you think by the end of 2023 that we'll get above that trend line, or we'll still be below it? 67% think that we will end up being above it, where 33% thought that we will be below, or think that we will be below. We still don't know the answer to that. We won't know until the end of the year. Then I also asked, November is a strong month historically, and it tends to be the best month according to the Stock Traders Almanac. However, we might be coming into some short-term historical weakness, and that's what we were hitting this past week. Do you feel that this will produce a decline, or will the market remain positive? We were split 50-50 on how folks felt about that. A week ago, on November 17th, we're looking extreme positive. We're still looking extreme positive right now. But at that time, I asked, do you feel that this will produce a pullback, or is this just suggesting that there's good momentum in the market and will ultimately go higher? 67% thought that that's good momentum, where 33% think that we were going to see a pullback. We were up 1%, so we are continuing to move higher in the market. The upcoming week will be Thanksgiving. That's now passed as the time I record this, followed by a shortened session on Friday. Now, sometimes when we see these shortened sessions, and a lot of people are gone, if some big player wants to come into the market and buy or sell, that can produce a lot of gyrations in the market. Well, we ended up seeing a pretty sleepy session, and 43% of the people thought that, yeah, that's what we were going to see, just sideways action, where 57% thought that we were going to see some kind of a big move. Didn't really play out that way. Getting into some Isabel Net blog charts. I know this looks the same, but I update this every week, believe it or not. You can see down on the bottom the date that this chart was updated, but this is justifying higher prices for the market. We're seeing earnings projections still looking positive going out into the future, whether it's Morgan Stanley or the overall consensus. As long as these numbers are going up, when we get into an uptrend with the market, that's one of the reasons why, because earnings ultimately determine stock prices. And you're not buying earnings what they are right now. You're buying earnings what they're going to be somewhere down the road. And as long as they're going up, that's why people like to invest in certain stocks. Then we look at what's called the Economic Surprise Index. And this is what we're going to be keeping an eye on. When this was going up, that's the dark blue line here. When this is going up, that means that the reports that are coming out are stronger than expected. And sometimes, okay, the market can go up with that if it wants a stronger growth environment. But what we've been seeing lately is that these economic reports have been coming out and they've been weaker than expected. And that's been helping to give some support to the S&P. The market is constantly going back and forth between good news is good news and bad news is bad news. Lately, bad news has been good news, but if we get too far in that direction, bad news could end up becoming bad news. We also keep an eye on the earnings per share. This is another way to look at it going forward. We're looking out from Goldman Sachs. They think that we're going to go up with the earnings per share, which also justifies prices going higher. We had one post from FactSet where every time there's an earnings call, because they release their earnings and then they have a conference call where people can listen in and ask questions, they have keywords that they're looking for in these calls. Last week, it was inflation. This week, on this report anyway, it says how many times were companies talking about the word recession or that they brought it up. And that has really been trailing off. There's more of the conventional wisdom now suggesting that we may see a soft landing. We've been seeing economic slowdowns without necessarily going into a recession. Now, if you look at all the charts and you take all the evidence, you can make a strong case to say, yeah, we're going to go into a recession. But there's also another group of charts that you can look at to say, no, we're holding in there. Everything is going well for right now, and we may be able to avoid a recession. And so you have the debate going back and forth. So we just have to watch this play out, look at all the economic reports as they're released, see what's coming out of the Fed, and then looking to these gauges that we follow to see, are they showing some deterioration? The ones that suggest we're not going to go into a recession are still holding up, where there's other charts suggesting that, yeah, that might end up happening. Getting into our charts and analysis, here's the intraday chart. Starting on Monday, we saw a pretty solid up day. In fact, we went all the way up to R3. Then on Tuesday, we kind of went into sleepy mode where we were sideways. We did break higher on Wednesday, but then we ended up chopping sideways. And then Friday was really comatose, where we didn't get very far above or below the unchanged level. So for the week, we look at the different indexes. The Dow, the NYSE, and the mid-caps ended up being up the most. Now, this is just the 4 trading days. Some things that we look at go from Friday to Friday. This just looks at the trading days within the week, where you had the small caps, the NASDAQ, and the NASDAQ 100 ended up being slightly negative when you just take the past trading days. We're going back to the beginning of the year, the NASDAQ 100, the NASDAQ, and the S&P are up the most, and all of the other indexes are now positive for the year. But when we go back to the all-time high, all of the indexes are still underwater, with the small caps being down the most. Looking at our different sectors, we had an up week, so that's how I sorted this, where we had healthcare and staples. These are areas that have been under a lot of pressure. They saw a bit of a bounce back this past week. Communications been a stronger area in 2023, and it was up. Where energy, it goes through phases where it really shoots up and then it starts to come back down. It was up on the week, but it was down the least of the sectors. Looking at the performance over the last year, this is the relative rotation graph. As I always say, think back to your geometry class where you see the flat line, that's the x-axis. And when we're going to the right, that's a plus for the x-axis. If we're going to the left, that's a minus for the x-axis. Then we have the y-axis, which goes up and down. When we're going up, that's a plus. When we're going down, that's a minus. So looking in the right-hand corner, that would be a plus plus. We're going up, both with the x-axis and the y-axis. So the stronger areas are going to appear in this quadrant here. Well, energy had been quite strong, but now it's starting to show some weakness, and so it's turning yellow and actually coming down. Where we're seeing things like communication and tech and financials are seeing a little bit of love here. We actually turned back positive with the financial sector. These are showing some more strength, where we have the staples and industrials. They're showing some weakness right now, but then some other areas are showing a little bit of improvement as well, like utilities and real estate. But again, this goes back over the last year, and it just looks at the ETFs within these sectors. Then looking at the sectors, this is just going back for the week, showing that healthcare, staples, and utilities ended up being up the most, followed by materials. These are areas that have seen some weakness. They saw a little bit of buying this past week. This chart is erroneous, so we'll go on to the next one. When we go back to the all-time high, we have tech, communication, and discretionary doing the best. All of the other sectors are still underwater. Discretionary had been doing better, and then we hit the summer months and we saw some weakness there. It's still positive, but for the market to turn more positive, we want to see discretionary really start to perform better than it has been. Looking at sentiment, we're not necessarily extreme positive right now. We closed on Friday at 68. Looking at the historical chart, it's when we get up above 75. That's when we're looking a little too positive. And when we get to an extreme reading, that's when we look to use this as a contrarian indicator. As we're going from low back up to high, we can go with that and we can jump on for the ride as things are going up. But we're, at least on a sentiment basis. Now, this could turn down at any time, but usually we get to some kind of euphoric type of reading before we start to turn down, just like we turned really pessimistic back in October, and then up out of that, that's when we saw the market start to bounce back up. We also look at this sentiment gauge, the active asset managers, and they're human beings too, and they have pressures on them. They have to have performances. They have monthly and quarterly statements they have to send out. And if they see the market really going up, they have to jump in. Well, because they're emotionally based too, since they're human beings, when they get extremely pessimistic, we can use that as a contrarian indicator. And they are showing some improvement. They're more positive. When we'll get a little bit nervous is when we go above this red line here. That means they're getting a little too positive. We also have another chart of that same thing showing that we're coming in at 77.95, almost 78. When we get up above 90, that's when we start to look at this being extreme positive. Looking at the VIX, another fear gauge where the line chart is continuing to decrease as a lot of fear is going out of the market as the market's been going up. We're also decreasing with the bar chart as well. And we're actually starting to come down to previous lows that we haven't seen in quite a while. The Ulcer Index, the higher up this goes, the more nervous the market is. On the daily chart, we're actually showing where fear is really dropping off. We're going pretty much sideways now with the weekly chart, and we're still above the moving average. This is another sentiment gauge. When folks are really pessimistic, we see the RIDEX bear bull ratio really start to spike up. We're actually showing a pretty low reading right now, meaning that folks are fairly confident that the market's going to continue to go higher. When we get down to these low readings, sometimes we look at this as a potential contrarian indicator. We just want to be aware of that. Then we look at the latest reading from the American Association of Individual Investors, and they tend to react to what's already happened in the market. And this includes me, this includes you, anyone listening to these videos, you're in this category. This is also a group that you can join. And we're getting a little more positive on this, but we're not necessarily excessive positive for the time being. If we go back above 90, that's when we start to look at this as a contrarian indicator. In the meantime, we can just roll with it as it's showing some improvement. Then another gauge of sentiment is we look at cash, which is like really safe, but it really doesn't give you much of a return. And we compare that with the tech sector. When this black line is going down, that means the tech sector is really doing well. It ran into some problems in 2022. And now if you look way over on the right, the black line continues to go down. That just means the tech sector is outperforming cash. Keeping an eye on some economic data that we look at. This is the Atlanta Fed GDP now, and it tends to be rather optimistic here. They have the latest reading coming in at about a little bit of over 2% currently, but the forecasts are anywhere from about 1.75% to the upside and slightly negative to the downside. We will be getting another GDP update in the upcoming week. Here's what we look at on the bar chart, where here's the third quarter for 2023, and now we're starting to really focus on the fourth quarter of 2023, where according to GDP now, they see things as being positive. We also look at the spread between risky and not as risky bonds. If we were starting to see the market become very nervous, this ratio would be going up. It's now continuing to go down. Then I have a number of financial reports that are put out by the Fed. This is the Chicago Financial Conditions Index. We're dropping here, which is positive. If we were coming up and crossing above the black line, that would be more negative for the economy. Looking at, and this hasn't been updated for almost a month now. These are the tightening standards for banks where it shows that they have been coming down in the latest reading. And then we look at the real-time SOM recession rule indicator. We are going up, but we're not above the red line yet. If we cross above the red line, that's when we get nervous. This also hasn't been updated for a month. The smooth U.S. recession probabilities. We get nervous if we're above the red line. We're just kind of right on top of the black line. And the Brave Butters Kelly leading index. This had been going up, causing us some concern, but now it's been falling back. But be aware, this has not been updated since the end of October. Keeping an eye on inflation, and this is updated every day. This is Inflation Now casting, where we're going to get the PCE inflation report in the upcoming week. And so it's pretty much flat as we're getting closer to that report. What's gyrating around now are some of the projections for CPI. I think I have that right. Then looking at the Fed, and this is interesting. A week ago, there was 100% probability that the Fed was going to keep rates unchanged. Well, we saw kind of some mixed economic reports this week. Some were weaker than expected. Some were stronger than expected. The Fed is really looking at the employment situation. And with the weekly jobless claims actually going down and the continuing claims going down, that is the market just a little bit nervous to the point where there's 4.5% of the people right now that are surveyed that, and according to the market, that we might see rates raised 25 basis points at the next meeting. This changes every day. And so as we get closer to that December 13th meeting, we'll be watching this more and more. And we can get some historical perspective where the blue area, that's where we're at right now. And then a week ago, this is the 100% probability I was talking about. So as more reports come out, this will adjust. Looking at the Fed balance sheet, starting in June of 2022, that's when they said they're going to start lessening their balance sheet, and they've been doing that. We saw the spike up during the financial or the banking crisis that we saw last March, and now the Fed is continuing to decrease their balance sheet. This is a year-over-year change, showing how things are falling off of the Fed balance sheet. Looking at the advanced decline line, we're seeing some improvement here. We're above the moving average based on price, and we're showing some improvement above the moving average based on volume. So this is looking more positive. Then when we look at the new highs versus the new lows, it's not that we're seeing a real breakout in new highs, but we're not really seeing any new lows right now. And so that's helping our 4-week average and our 10-week average to be positive. The advanced decline ratio, we're starting to get extreme with the blue line on the daily chart. We're coming up above this 200 level, where when we look at this on the weekly chart, we're positive with both the blue line and the red line. So this is positive for right now, longer term. Accumulation distribution, which is a smart money indicator, it's above the moving average. And we're also seeing that positive on the daily chart. Our trend, we are showing a trending environment on the daily charts, where here we're showing a trend that's below its moving average and below 20. That suggests we're going sideways as the market potentially is shifting from a downtrend more into an uptrend. And you can see since the summer months, we've been coming down, even on the weekly charts, Now that we're starting to go back up, the ADX is trying to readjust. If we can cross back above the moving average and get back above 20, that would suggest a trending environment. With the green line on top, that means we do default to the positive trend or the positive movement of stocks. The Erin indicator is still negative, and it can take some time for this to actually kick into gear and see something. When the red line's on top, that means that sellers are more influential than buyers. The green line are sellers, and it shows that they are decreasing. When we take the two together, that's why the oscillator is below zero. It was flat this past week, but the fact that we're below zero is negative. Now, on the daily chart, we're looking more positive. The mass index is not generating a signal right now. We really pay attention to this when we deal with the red dash line and the blue line. Looking at the daily chart, we are seeing a pretty healthy pattern. Now, not a lot of swings here, but we're seeing a series of higher highs and higher lows. That could change at any time, but we were also able to get above this pivot level, which had been acting as overhead resistance, and we're still above it right now. We're also coming back to this previous high, which could act as a resistance level as well. On the bottom, we can see where the volume just continues to drop off and is well below average. Going back to a trend channel that goes to 2009, we're above the midpoint, and that gives us more of a positive slant. Looking at the pivot points, and this is what happened last summer. On July 31st, we hit this R1 level, and then that's when the market started to pull back. And these pivot lines stay on here for a long time. Well, now we're starting to come back into this area again. So we want to keep an eye on this. It's about the 4608 level, a little bit over 4600. If we come up to this area, are we going to break through and go to the upside, or is this going to end up providing some kind of resistance? Then looking at the trend on the 50-period simple moving average, which would be a 200-day moving average, simple moving average, the red line is going up, that's positive, and price is above that, so that's also positive. We're also looking okay with our longer-term trend where the blue line is above the red line and price is above both. We're seeing some improvement here, and we might be getting a little extreme with the McClellan oscillator. We're getting to an extreme reading. We could still go higher than this, but sometimes this marks some kind of an exhaustion point when this finally tops out and starts to come back down. Looking at the summation index, which is longer term, we're above zero and advancing based on price and volume, so that is turning more positive. The Swenlin trading oscillator, we're a positive based on price and volume since we're above the zero line for both. And we're seeing pretty much the same thing with the bullish percent index. This measures the point and figure buy or sell signals inside the S&P 500. And that is suggesting that we're seeing more strength inside of the index. We're above 50 and advancing and not necessarily extreme. Even when we've been chopping sideways and had a down day here and there, this has been continuing to go up, and that could be a healthy sign. Looking at the momentum, though, the PMO, it's starting to turn back up, and we're above zero based on price and volume. When we look at our PMO studies, and we're seeing the same thing on the daily chart, we're extreme with the PMOs that are rising and the buy signals, where we're still positive with the PMOs that are above zero. Looking at the Bollinger Bands, the percent B indicator measures when we go outside of the upper or lower Bollinger Band. That doesn't happen very often. We can also use this to get our bias because we're above the midpoint and advancing. So that's looking more positive. Then we look at all of our oscillators together, and we are seeing some improvement with the slope and TSI. We're trying to turn back up and show some improvement with our intermediate term indicators, the MACD, the PMO, and the PPO, where we're still declining with our longer term oscillators. Taking money flow, another smart money indicator, it's still negative, but it is starting to turn back up and showing a lot of improvement. The Chaikin oscillator is above the midpoint and going up. That's positive. The force index is positive above zero. The money flow indicator, where we're coming off of an overbought signal on the daily chart, we're crossing back above 50 here on the weekly chart. That's positive. The rate of change going back 1 week, we were still up on the week, even though it wasn't as big of a move as what we've seen over the last few weeks. Going back 50 weeks, this is showing some improvement. Where we get a little nervous is if we continue to go up and cross this next red line a little bit higher. That's when we may have gone a little too much to the upside. Looking at the RSI based on 14 weeks, we're above 50 and advancing. That's positive. The weekly, special K chart is negative, where the daily chart has now switched back to positive. The Stochc RSI is extreme positive, but other times when we're in a really strong market environment, it can stay camped out here. There's other times when it just comes up and then immediately goes back down. We're also seeing that same kind of thing with the Williams percent R. It is now extreme positive. It can stay up here for long periods of time, or it can just dip into this area and then produce some kind of a reversal. The ultimate oscillator is above 50 and advancing. That's positive. The vortex, the green lines on top, we're getting rather extreme on the daily chart. It's getting up to these higher lines here and actually starting to turn down. But on the weekly chart, we have turned more positive. The Copic curve is now crossed over positive. That's longer term positive as well. And we're not really dealing with any of the moving averages or longer term support levels now. We're watching this to see, are we going to come back to this previous high? If we can break above that, we might give a challenge to the all-time high, but we have to get through this area first. We might come up here and then end up coming back down, or will we be able to break through to the upside? Our different charts on a trending basis, all of our chart variations are positive, with the hike in ASHI, with the open candles. The Kegi has a black line pointing up, that's positive. The Renko has open boxes, that's positive. And the 3-line break is also positive. There are two different things that I have on this chart. There's equi-volume. When it's an up day, it's green. When it's a red day, it's down, it's negative. And then the thicker the bar is, the more volume went into that move. So we can kind of get a graphical representation. And this is looking more positive, even though the bars are not all that thick. That means that we've been seeing a decrease in volume. On the bottom, we try to measure the path of least resistance. The ease of movement, if it's going positive, that means the least resistance is to the upside. And we have been seeing some improvement as we're crossing above 0. We did get a new X on the point and figure chart. This does not take time into account. This just, no matter if it takes an hour or a year, it'll only draw in an X when a certain gain is experienced based on price. And so we did see a new X drawn this past week, and we're coming off of a signal that was generated on November 20th of a double top breakout. Then looking at some trading systems that we follow, we're neutral with the daily chart for the S&P Elders Impulse system, but we continue to be positive here on the weekly chart. And our parabolic SAR system, when the dots are underneath, that's positive. And we're seeing a confirmation between the daily chart and weekly chart. Another momentum study, the long-term PPO is showing some improvement. We're flattening out, but still positive in the intermediate term. We're rolling over, but still positive in the short term. And then I go through the daily charts that I use and pick out what might be interesting right now. Sometimes I have a long list. Sometimes it's not very long. We're keeping an eye on this trend line study, not so much because we're dealing with sloping trend lines, but we're coming back and we're right above this previous high, at least on an intraday basis. Can we hold this level, and is the S&P going to end up going up from here? We also keep an eye on the NASDAQ 100. There's a lot of mega caps there. There's also mega caps, the same mega caps that are in the S&P 500, and we're still hanging in there pretty good with the NASDAQ 100. We're not back to the all-time high yet, but we were able to get above this red line, which has acted as resistance numerous times. We were also able to get above this pivot point, which had been acting as resistance. Then this is a bit of a concern. The bullish percent index, which are the buy or sell signals for the NASDAQ 100, it became extreme positive and is starting to roll over. If it drops below 70, that would be more of a negative or an overbought indication. And this is the big mega cap. So we want to keep an eye on this. Now, other times we got a real high reading, it came back down, and then it went back up. We don't know if that's going to happen this time, but if this continues to fall, that could be kind of a major warning sign. Then we're looking at the FANG index, which is Facebook, Amazon, Netflix, Google, and a bunch of others. We did set a new intraday all-time high here, but on a closing basis, we have not exceeded this previous all-time high. Then we look at the 10-day average of the S&P 500 highs minus the lows, and there's two ways you can look at this chart. We are starting to get extreme positive, which may point to exhaustion and due for a pullback. You can also look at this as good momentum, because we can stay up in this area for a long period of time when the market is really moving up. Then we also are seeing some improvement in the broad market, where we take a 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE. For the first time in quite a while, we're turning back more positive. The longer we can stay above this, the longer or the more the broader market is showing some improvement. And then this is a longer term measure too, where we finally were able to cross above zero with our 50-day exponential moving average of the new highs minus the new lows. This had dropped to negative and has been showing a lot of improvement lately. This is also getting extreme with our 19-day exponential moving average of the advanced decline ratio. We're getting to this upper reading based on price, but we're not there yet based on volume. Some broad market measures. First, we look at seasonality from 2019 to 2022. We are up in the month of December 75% of the time. So far for November, we tend to be up 80% of the time, and we're getting a return of 5.5%. Then when we look at just a blanket, no studies on this chart of the S&P mid caps and small caps, we are seeing some improvement with the S&P. But you notice the mid caps, even though they're going back up, we want to see more strength here. We also want to see more strength coming out of the small caps than what we're seeing. But when you look at the trend of the Dow, we're above the moving averages and going higher. So that's positive. The NASDAQ is also in an uptrend. The NASDAQ 100 is in an uptrend. The mid caps, they're still in a downtrend, and they've been really choppy. This is an area we want to keep an eye on. Can we break out to the upside here and show some improvement? And we're seeing a very similar picture here with the small caps. They're still in a longer term downtrend. Can they break out and show some improvement? The NYSE, another broader measure where we crossed over negative here, it has been bouncing back. If we can stay above these lines, we will generate a golden cross. All stocks are also showing some improvement after seeing some weakness. The 30 biggest software companies did generate a death cross. Now they're starting to bounce back up. The FANG index, we're coming back, and on an intraday basis, as I talked about, we're setting a new all-time high, but we're not necessarily setting that on a closing basis, at least very convincingly yet. ARC is seeing a little bit of an improvement after generating a death cross. We're bouncing back up. The longer we stay above the moving averages, we are more likely to see this turn back up. Looking at the banks, where we're seeing some improvement here with the RSI, we're above 50. And we're also seeing more positive momentum as the bank stocks have really been under pressure. The deposits continue to show an outflow. I know by looking at this chart, it looks like they're up. So you want to look at this number over here, which is minus. Then looking at just a generic chart of the Dow and the transports, that's traditional Dow theory. We are a little bit concerned right now. The transports, even though they're bouncing up, they're not moving up with a lot of conviction, where the Dow is looking a little bit more positive. The utilities are showing some improvement here as well, and I include that as part of Dow theory. Some broad market measures, the CRB index is still in an uptrend, even though it's been pulling back as of late. Oil, after getting up to 95, is now down around the 75 level. Copper is still showing some weakness, which, as we're seeing weaker than expected economic reports, that's why we've been seeing this continue to go down. But the dollar is still in a longer-term uptrend, even though it has been pulling back. Gold is still in a longer-term uptrend, and this really spiked up when the geopolitical events started to unfold in Israel, and now it's been pretty much chopping sideways since then, where silver is in a longer-term downtrend and has also been chopping sideways. Keeping an eye on bonds based on price, we're still seeing an overall death cross here, or downtrend, but bond prices have been bouncing back up. When we look at a ratio between stocks and bonds, stocks are continuing to outperform bonds. Then this is a little bit of a concern, but it might be explained away by the holiday weekend. When you take the 1-month yield and subtract the 3-month yield, you should always get a negative result, because the 3-year yield should be higher than the 1-month yield. We're actually positive after Friday's session. Where we saw this real gyration, that was when the debt ceiling crisis was unfolding late last spring. Looking at the daily chart of the yields, where we have been going up pretty much across the board, now we're starting to see interest rates coming back down. A weekly chart with the US and UK tending to come down overall with their rates. Germany is also declining a bit, and Japanese rates have been falling, even though they all ticked up a little bit in this past week. Some relative studies. First, we look at an intermarket analysis chart going back to the beginning of 2023. Stocks are doing the best, followed by gold, the dollar, and then oil, where bonds based on price continue to be negative. Going back to the beginning of 2022, oil is still doing the best, followed by the dollar, gold, and stocks and bonds are still negative. We look at a ratio between the NASDAQ 100 and the S&P 500. Both have been doing well, but the NASDAQ 100 has been doing better. The S&P pulled back a little bit with the S&P 100 compared to the S&P 500, but overall, the bigger stocks are outperforming the rest of the S&P. Growth to value ratio is also more positive. That's the buy low and sell high, there. That's a good one. But we want to see some more improvement here and see a more established uptrend. When we look at gold to the S&P, it's really been underperforming as the S&P has been going up, as gold has been chopping sideways. And gold is also underperforming the rise in the dollar, even though this ratio is going back up slightly. Bonds are underperforming stocks when we look at shorter term maturities. And when we look at the low volatility to S&P 500 ratio, we did break down below these previous lows, even though we ticked up a little bit this past week. But the low volatility stocks have been underperforming the S&P. Discretionary continues to outperform staples. Discretionary is more growth oriented, where staples are more value or defense oriented. Energy had been bouncing back compared to tech, but now it's starting to show some weakness, and longer term, energy continues to underperform the tech sector. Some longer term studies. This is an NYSE breadth thrust, which now over a year ago triggered a buy signal. That was in October of 2022, and this is still indefinitely on the books. Then we had the ZWAG NYSE breadth thrust, which we had one signal that was generated in March, and then back in October, we saw another signal generated, and these signals are rare to see two so close to each other. That could be longer term positive for the market. But this is a concern. This is a hard check. It had been giving us a solid buy signal for most of 2023. Then it dropped down to this 4 area. Now it's dropped down to -6. If it goes all the way down to -10, that's a sell signal. Now, there's other times when we dropped this low and then we were able to bounce back up. So we'll be seeing if this chart shows some improvement. But this is a bit of a warning sign to us. A longer term chart, a weekly chart going back to the 87 crash, connecting it to the .com low, and then extending that trend line forward. We're starting to come back up to the underside of this trend line. Here's a blow up of that same chart, just going back to 2018, where we're not there yet. We haven't quite reached this trend line, but we're getting kind of close. If we do go up to this level, that could be providing overhead resistance. And then we look at the NASDAQ 100 weekly chart. We're still underneath the trend line, but we're getting close to that. Then we look at a ratio between the NASDAQ 100 and the Dow. We still have a ways to go back to this previous high, looking at this ratio. And so this is still looking positive for right now. We look at the Qs, which is the NASDAQ 100, and we take a ratio to the small caps, which is the IWM. That's the Russell 2000 ETF, where we went above this blue line and now we're starting to come back down. We watch this longer term, and if it really starts to decline, that could be negative for the market, but we don't really see that yet. Then looking at the cumulative new highs, new lows for the NASDAQ, it's been negative for a number of years now. We are showing a positive reading here when we just take the new highs minus the new lows. If we can camp out above the 0 line, that would eventually help this turn back up, but it's just not happening yet. And then we're keeping an eye on the 3-month yield, where we went above where we were back in 2007. Once this topped out, then we started to really go down as the great financial crisis unfolded. We've exceeded that high, and now we're starting to roll over again. We're wondering, is this even relevant? But we want to keep an eye on this just in case it might turn relevant. Then Tom Bowley's research, we're coming into the latter part of November where we tend to see more positive action. So, and this is just for Monday's session. What's our outlook for Monday? We're still dealing with earnings. We're still keeping an eye on the geopolitical events, especially in Israel. The technicals are positive on the daily charts, but we're overbought. Some of our indicators are showing some weakness, and some of that can be the way they're calculated. It also could be suggesting that maybe we're getting exhausted and due for a pullback. We will get the new home sales on Monday, and then we're keeping an eye on the whole list of geopolitical events. Here's the economic calendar for the upcoming week. We're going to get another reading of GDP on Wednesday. The big one is going to be PCE. That's an inflation report on Thursday. We're also going to get a very influential report on Friday with the ISM manufacturing. The Stock Traders Almanac statistics for Monday, November 27th, we are positive across the board. We've now gone beyond options expiration week. Then looking at some seasonal charts where we're positive with the green dashed line, that will be the 18th trading day of the month. And we're also positive when we look at the solid green line. We're also seeing positive seasonality for the month of November when the current president is running for re-election. We're also seeing positive seasonality here where the black line continues to show improvement. Doesn't mean it's straight up, and it doesn't mean this is how things are going to happen. This is just how they have happened historically, and we use that as a guide. Also, going from 1950 to 2022, we do see positive seasonality going forward. And then comparing election years to non-election years, we do see some positive seasonality, even though we drop off in the latter part of December when it's a pre-election year. Then, looking at the Carson research, they tend to pick up a little bit of weakness between about now and the first part of December before they see positive seasonality going forward. Looking at the Stock Traders Almanac study here for the NASDAQ, we're coming into the latter part of November where we tend to see positive seasonality. We also see that with the green line, which is the S&P 500 towards the latter part of November. Then Carson also put this out where Monday and Friday tend to be the positive days, followed by Thursday, where for in 2023 anyway, Tuesday and Wednesday tend to be negative. So the scenarios, and again, this is just based on the daily charts and it's only for Monday's session. We're not looking at the downtrend. There's really no real evidence for that right now. Yeah, we might be overbought. Yeah, we might be showing some weakness, but we're not really seeing any proof as far as a trend that we're starting to go down. So if anything, we still lean to the upside. We're not going with the sideways trend on the daily charts because it shows we're trending. On the weekly charts, it shows that we're not trending, but that could change if we see some more positive price action. The warning signs, and I've added this back and forth between these slides. We were getting kind of more positive here when the 5-period equity put call ratio spiked and then started to come down. Well, and this could be explained by hedging over a holiday weekend. It's starting to go back up, and that's a bit of a concern. We'll see if that changes as folks come back after the holiday. These hedges are taken off of their positions. We'll see if this ratio starts to go back down. The risk on posture, longer term, it's still showing weakness. It bounces up, but it's not really convincing right now. The Russell, the small caps, and the mid caps continue to be in downtrends. Then longer term, we're still underneath those long-term trend lines for the S&P 500 and the NASDAQ, and the cumulative new highs and new lows for the NASDAQ. We're seeing some improvement there, but longer term, we're still showing weakness. The 3-month yield is above where it was back in 2007. It's starting to turn down. We're wondering, is that going to be relevant this time or not? And then there's the Horchak method. We're getting kind of working off of that buy signal, and we're in danger of actually generating a sell signal, and that could be longer term negative. And then earnings as they are released. Then looking at the positive signs, longer term, we're starting to see the 253-period equity put call ratio show a little bit more convincing move to the downside, and that could be positive for stocks. The daily special K chart is positive, where the weekly chart is negative. On a momentum basis, the S&P and NASDAQ 100 continue to be positive. The parabolic SAR chart and the vortex, they are both positive, but the vortex is getting kind of extreme with that green line and is starting to roll over. The bullish percent index is above 50 and advancing, and that's positive, and it's not extreme right now. Small and mid-cap growth has been more or less positive, but it's been chopping sideways. We want to see some more improvement there. The financial sector has generated a golden cross after just a week or two ago generating a death cross. And the 50-period moving average study of the new highs, new lows, that is now coming back above zero. The positive signs that are longer term, we have 2 ZWAG NYSE breadth thrust signals, one last March and one again in October. They're very rare, and to see 2 of them so close to each other could be positive. Seasonally and historically, November tends to be the best month of the year. December ends up being positive as well. But longer term, the seasonality and setups, those are still in the background. But we're a little bit concerned about this Zahorchak showing some weakness here. We're still above the downtrend channel upper line. I haven't been showing that chart because we're far away from that trend line. So our conclusion for Monday's session, and we can say this across all the different time frames, we are positive but overbought. There's potentially some weakness that we're seeing in our indicators, but they haven't actually turned negative yet. We're still positive in the long term because we're above the 200-day moving average. Thank you. I hope you found this helpful. Please feel free to check out the daily videos. After this, I will be preparing the intermarket analysis video, followed by the deep dive video. I hope you had a wonderful Thanksgiving and are having a wonderful weekend.